One number. That is the difference between a rental property that builds your wealth and one that quietly drains your bank account every single month. Most new investors obsess over purchase price, location, even the color of the kitchen cabinets. But the investors who actually get rich from real estate, they obsess over one thing: monthly cash flow. Today, I am going to walk you through exactly how to calculate it, step by step, with 3 real deals so you can see how the math works in practice. Let's start with why cash flow matters more than almost anything else in rental property investing. Cash flow is simply the money left over after you collect rent and pay every single expense: mortgage, taxes, insurance, repairs, everything. If you have $200 left over each month, that is positive cash flow. If you are $200 short, that is negative cash flow, and you are paying out of pocket to own that property. Here is why this matters. Appreciation is speculative. You hope the property goes up in value, but you cannot control that. Cash flow is predictable. It pays your bills today, not in some imaginary future. A property that cash flows $300 per month puts $3,600 in your pocket every year, regardless of whether the market goes up or down. And here is the real power. When you stack 5 or 10 properties, each producing $300 per month, that is $1,500 to $3,000 per month in passive income. Quick tip: the best investors I have studied buy for cash flow first and treat appreciation as a bonus, never the other way around. Now let's break down the actual formula. Rental property cash flow has 3 layers, and I want you to remember this structure because everything else builds on it. Layer 1, gross rental income. This is the total rent you could collect if the property is fully occupied for 12 months. If rent is $1,800 per month, your gross annual income is $21,600. Simple. Layer 2, operating expenses. These are all the costs of running the property that are not your mortgage. Property taxes, insurance, maintenance, property management fees, vacancy allowance, and a few others. We are going to break each one down in detail in the next section. For now, just know that operating expenses typically eat 35 to 50% of your gross rent. Layer 3, debt service. This is your mortgage payment, principal plus interest. If you bought with a loan, this is usually your single biggest monthly expense. The formula is simple. Gross rent minus operating expenses minus mortgage payment equals your monthly cash flow. That is it. $1,800 in rent minus $720 in expenses minus $780 in mortgage equals $300 per month in cash flow. Let's make it even clearer with the exact expense categories. This is where most new investors get it wrong. They calculate rent, subtract the mortgage, and think the rest is profit. It is not. There are 8 expense categories you need to account for, and skipping even one can turn a profitable deal into a money pit. Number 1, property taxes. Typically 1 to 2% of the property value per year. On a $200,000 property, that is $2,000 to $4,000 annually, or $167 to $333 per month. Number 2, insurance. Landlord insurance runs $800 to $1,500 per year for a standard single-family rental. Budget $100 per month. Number 3, maintenance and repairs. The industry standard is 1% of the property value per year. On a $200,000 home, that is $2,000 per year or $167 per month. Some investors budget more for older homes. Number 4, vacancy allowance. No property stays rented 100% of the time. Budget 5 to 8% of gross rent for turnover gaps. On $1,800 per month rent, that is $90 to $144 set aside monthly. Number 5, property management. If you hire a property manager, expect 8 to 10% of collected rent. That is $144 to $180 per month on $1,800 rent. Even if you self-manage, budget this. Your time has value. Number 6, capital expenditures. This is your reserve fund for big-ticket replacements: roof, HVAC system, water heater, appliances. Budget 5 to 10% of rent, or roughly $90 to $180 per month. Number 7, HOA fees. If the property is in a homeowners association, this can range from $50 to $500 per month. Always check before buying. Number 8. Utilities. If you cover water, trash, or any utilities for the tenant, include them. Typically $50 to $150 per month. Quick tip: always ask the seller for actual expense receipts from the last 2 years. Estimated expenses are wishful thinking. Real receipts tell the truth. Before we dive into the real deal examples, let me give you a quick screening tool that professional investors use to filter deals in seconds. It is called the 1% rule. The 1% rule says that the monthly rent should be at least 1% of the purchase price. If you buy a property for $200,000, it should rent for at least $2,000 per month. If you buy for $150,000, it should rent for at least $1,500. Why does this work? Because properties that hit the 1% threshold almost always cash flow positively after all expenses and mortgage are paid. Properties below 0.7% almost never cash flow. They rely entirely on appreciation. Now, here is the reality. In expensive markets like San Francisco, New York, or Los Angeles, you will almost never find a property that hits 1%. In those markets, a $800,000 home might rent for $3,500. That is 0.44%. Negative cash flow territory. But in markets like Memphis, Cleveland, or Indianapolis, the 1% rule is very achievable. You can find $150,000 homes renting for $1,500 or more. This is why cash flow investors tend to focus on Midwest and Southeast markets. Quick tip: the 1% rule is a screening tool, not a final answer. Always run the full cash flow calculation before making an offer. Now let's put this all together with 3 real deals. Deal number 1, the winner. We are looking at a duplex in Memphis, Tennessee. Purchase price: $185,000. Each unit rents for $950 per month, giving us total gross monthly rent of $1,900. Let's check the 1% rule. $1,900 divided by $185,000 equals 1.03%. We pass. Now let's run the full calculation. Gross monthly rent: $1,900. Property taxes: $180 per month. Insurance: $110 per month. Maintenance at 1% of value: $154 per month. Vacancy at 5%, $95 per month. Property management at 8%, $152 per month. CapEx reserve at 5%, $95 per month. Total operating expenses: $786 per month. Net operating income, that is rent minus operating expenses, equals $1,114 per month. Now subtract the mortgage. We put 25% down, $46,250, and financed $138,750 at 6.5% for 30 years. Monthly payment: $877. $1,114 minus $877 equals $237 per month in positive cash flow. That is $118.50 per door. Not spectacular, but solid. And here is the key: we still have not factored in principal paydown, which adds roughly $220 per month to our equity. Your tenant is literally buying this property for you. Total cash invested: $46,250 down payment plus $8,000 in closing costs, totaling $54,250. Annual cash flow: $2,844. Cash on cash return: 5.2%. Add principal paydown, and you are looking at a total return above 10%. Deal number 2, the trap. This is the deal that looks amazing on the surface, but bleeds money every month. We are looking at a 2-bedroom condo in Austin, Texas. Purchase price: $385,000. Market rent: $2,200 per month. Sounds decent, right? Let's check the 1% rule. $2,200 divided by $385,000 equals 0.57%. That is a major red flag, but let's run the full numbers anyway. Gross monthly rent: $2,200. Property taxes in Austin: $640 per month. Texas has no state income tax, but property taxes are brutal at 2% of value. Insurance, $130 per month. HOA fees, $350 per month. There it is, the silent killer. Maintenance, $321 per month. Vacancy at 5%, $110 per month. Property management at 10%, $220 per month. CapEx at 5%, $110 per month. Total operating expenses, $1,881 per month. Net operating income, just $319 per month. Already razor thin. Now the mortgage. 25% down on $385,000 is $96,250. Financing $288,750 at 6.5% for 30 years. Monthly payment is $1,825. $319 minus $1,825 equals negative $1,506 per month. You are paying over $1,500 out of pocket every month to own this property. That is $18,072 per year in losses. This is not an investment. This is an expensive hobby. The three killers here? 2% property tax rate, $350 HOA, and a purchase price too high for the rent it commands. The 1% rule flagged this instantly at 0.57%. Quick tip: if a deal fails the 1% rule and has an HOA above $200, walk away immediately. That combination almost never works for cash flow. Deal number 3, the break-even. This is the tricky one because it sits right on the edge. Single-family home in Indianapolis, Indiana. Purchase price, $210,000. Rent, $1,650 per month. The 1% rule gives us 0.79%. Below 1%, but not disastrous. Let's see what the full numbers say. Gross monthly rent, $1,650. Property taxes, $175 per month. Insurance, $105 per month. Maintenance, $175 per month. Vacancy at 5%, $82 per month. Property management at 8%, $132 per month. CapEx at 7%, $115 per month. No HOA. Total operating expenses, $784 per month. Net operating income, $866 per month. Mortgage, 25% down, financing $157,500 at 6.5% for 30 years. Monthly payment, $996. $866 minus $996 equals negative $130 per month. That is negative cash flow, but only barely. So is this a bad deal? It depends on your strategy. If rents increase by just 5% to $1,733, this property flips to positive $47 per month. If you self-manage and eliminate the 8% property management fee, you save $132 and the property cash flows $2 per month right now. And Indianapolis has seen 4 to 6% annual rent growth over the past 5 years. This is what I call a strategic break-even, a deal that does not cash flow today, but is one rent increase away from profitability in a market with strong rent growth. Let's put all 3 deals side by side so you can see the pattern clearly. Deal 1, the Memphis Duplex at $185,000. Cash flow positive at $237 per month. Passed the 1% rule at 1.03%. A clear winner. Deal 2, the Austin Condo at $385,000. Negative $1,506 per month. Failed the 1% rule at 0.57%. Destroyed by high taxes and HOA. A money pit. Deal 3, the Indianapolis single family at $210,000. Negative $130 per month. Borderline at 0.79%. A strategic hold in a growing market. Notice the pattern. The purchase price alone tells you nothing. A $185,000 duplex was the best performer, while a $385,000 condo was the worst. Cash flow analysis is what reveals the truth behind the listing price. Before we wrap up, let me give you the 5 biggest cash flow killers that I see destroy rental property returns over and over again. Killer number 1, high HOA fees. Every dollar in HOA comes straight out of your cash flow. Properties with HOA fees above $300 per month rarely cash flow unless the rent is exceptionally high. Killer number 2, deferred maintenance. That cheap fixer-upper looks great on paper until the $12,000 roof replacement hits in year 2. Always get a full inspection and budget for major repairs. Killer number 3, overestimating rent. New investors look at the highest comparable rent and assume they will get it. Use the median rent for your analysis, not the best case. Killer number 4, underestimating vacancy. In most markets, you should budget 5 to 8% vacancy. In college towns or seasonal markets, budget 10 to 15%. One extra month of vacancy per year cuts your annual cash flow by 8.3%. Killer number 5, ignoring property management costs. Even if you plan to self-manage, include 8% management in your calculations. Your time is worth something, and someday you might want to step back. If the deal only works with free labor, it is not a good deal. Quick tip, run every deal twice. Once with optimistic numbers, once with conservative numbers. If the conservative scenario still cash flows, you have found a solid investment. Which of these 3 deals would you invest in? The Memphis Duplex, the Indianapolis single family, or would you pass on all 3? Drop your answer in the comments. And if you want to see us break down specific markets for cash flow investing, hit subscribe and turn on notifications so you never miss an analysis. See you in the next one.